Hello everyone. In this video, I will be talking about asset and cash flow beta. So far in the previous videos in this week, we have seen that weighted average cost of capital is the weighted average cost of debt and weighted average cost of equity. Now, this after-tax weighted average cost of capital basically depends on average risk of the firm's assets. Okay. But we need to remember that it also depends on taxes and financing. So it's easier to think about project's risk if you measure it directly. Okay. And this direct measure is called asset beta. Now, asset beta is calculated as the same way. Asset beta is calculated as the same way we calculated the weighted average cost of capital. So you can see that asset beta is a blend of cost of debt and cost of equity. So this is the beta of a particular project, and this is the cost of debt associated with that project and cost of equity associated with that project multiplied by the proportion of debt and proportion of equity. And as you see that calculating an asset beta is similar to calculating a weighted average cost of capital, and the proportion of debt and equities or the weights of debt and equities are the same. Now, logic is also there the same. Suppose you purchase a portfolio consisting of 100% of the firm's debt and 100% of its equity, then you would own 100% of the firm's asset. Okay? Now, the beta of your portfolio is equal to the beta of all the assets of the firm. So the portfolio beta is, of course, just a weighted average beta of the debt and equity of the firm. Now, if you look at this diagram here, we have expected return and we have beta. And you can see this is the beta of debt, and which is definitely lower than the overall asset beta, which is 1.14, and you can see that beta of equity is higher, 1.24 from the overall asset beta. So as we already know, that equity is more riskier compared to the overall asset, and debt is less riskier, and that's the comparison for the rate of return for these different sources and their beta. Now, if a company wants to set a cost of capital for one particular line of business, they typically look at pure play in that line of business. So what does this pure play means? Pure play companies are, for example, public firms that specializes in one activity. So it could estimate the average beta or the cost of capital for pharmaceutical companies that have not diversified into consumer products. Okay, for example, let's say the baby powder or so. And if you look at this example here, the average asset beta will be based on different proportion of funds invested in each asset. Okay, and the beta of this each asset is basically indicating the riskiness of this project, assuming that that's the only line of the business of the company. So for example, if it is new ventures, the beta is 2. If they expanding existing business, beta is 1.3, and plant efficiency, beta is 0.6. So if these are the three different types of assets or the three different types of business a firm has, the average asset beta is 1.3, considering equal weights of each of these three lines of business. Okay, and you can see that discount rate, for example, speculative ventures are 15%, new products has 8%, expansion of existing business is 3.8%, and cost improvement has 2%. So discount rates are higher for the higher beta or high risk project, or lower for the lower beta or low risk projects. We continue to discuss our asset beta. Now we will introduce the concept of the cash flow beta or revenue beta. Now, intuitively, many people think the association between the earnings or the cash flows with that of the overall earnings or cash flows of the economy. Okay, so what really counts is the strength of the relationship between firms' earnings and the aggregate earning on all real asset. Okay, so when we are talking about beta, Previously, when we calculate beta of a stock return, so what we actually found out, the sensitiveness of individual stock return towards the overall market movement. Now, you understand that a firm's asset or firm's revenue or firm's earnings also can be sensitive to the overall earning of the economy or overall revenues of the economy. So in that case, ideally it's possible that we calculate earning beta or cash flow beta. Okay, these are just like a real beta, except the changes in earnings or cash flows that are used in place of the changes in the rate of return in securities that we have seen earlier. Now, what causes these variations? Sometimes some firms are cyclical firms. So cyclical firms are the firms whose revenues and expenses are strongly dependent on the state of the business cycle. Okay, so they tend to be high beta firms. So high beta means the firm's revenue betas or earning betas are higher because they are pretty much sensitive to the business cycle. Business cycle means if the overall economy is doing good, these firms do good, and if the overall economy is doing bad, these firms also perform bad. So these firms' revenues and earnings will be sensitive to business cycle, and these firms tend to have higher beta, for example, higher revenue beta or earning beta. So you should demand a higher rate of return for investment for the firms where performance is strongly tied to the performance of the economy. Example of cyclical business includes airlines, luxury resorts, restaurants, construction, steel, etc. Now, this is one point, the sensitiveness to business cycle. If you can remember, at the very start of this chapter, I said about three factors. One was the sensitiveness to business cycle, another was operating leverage that actually indicates that whether a particular firm or a particular project is more risky or less risky than the overall riskiness of the project or of the firm. So the second point is operating leverage. Operating leverage is the proportion of fixed costs in the firm's total cost structure. If a firm has more fixed costs, the firm becomes more risky because higher fixed cost means you cannot change your production cost when the demand of your product changes. That means what I want to say that if the economy is doing bad, the demand of your product goes down, you cannot reduce your production cost because majority of your production cost is fixed. In that case, your firm will become more riskier, okay, and you tend to have a higher beta. Now, the cash flows generated by an asset, if we talk about the cash flows can be divided into different components. For example, revenues, fixed costs, and variable costs. So if we think about an equation, all of you know, the cash flow equals to what? Revenue generated from sales minus fixed costs, the proportion of the cost that remains the same irrespective of level of production, and minus variable cost. Variable cost is the proportion of the cost that varies with the level of production. Now, we can think in this way that the present value of an asset or a present value of a project should be what? Present value of an asset should be equal to the present value of revenue minus present value of fixed cost minus present value of variable cost. Okay? And present value of revenue, on the other hand, will be the present value of fixed costs plus present value of variable cost plus present value of asset. Okay, so that's what you can see here, that beta revenue is the present value of fixed cost divided by total revenue, present value of variable cost divided by total revenue, and present value of asset divided by total revenue. And here is the beta for fixed cost, beta for variable cost, and beta for asset. Now you need to understand one point, that this beta fixed cost should be about 0 because whoever receives the fixed cost receives the fixed stream of cash flows. Beta of the revenues and beta of the variable cost should be approximately the same because they respond to the same underlying variable, the rate of output. Therefore, we can substitute this beta revenue by beta variable cost and solve for asset beta. Okay, so here comes our asset beta, and don't forget that we are assuming beta fixed cost equal to 0. So a present value of revenue equals to will be the present value of the present value of revenue minus present value of variable cost should be equal to present value of asset plus present value of fixed cost. So you can see that beta asset equals to beta revenue, and present value of revenue minus present value of variable costs, and present value of revenue minus present value of variable costs equals to present value of fixed costs divided by present value of asset 1 plus, and this is beta revenue. So this is how we actually can calculate beta revenue, and which can contribute to calculating beta asset. Okay, there is a long discussion as well as some examples in the textbook. I will suggest that if you find difficulties understanding this, you go through the textbook, have a look. It will help you understanding, and if you still have any issue, you can send me an email or you can ask me if there is anything. Okay, so we are left with the last video for this week, where we will be discussing how we can incorporate possible bad outcomes in our estimation. Thank you very much.